The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Well, our pre-record session had some interesting comments between us about how we often cover so many things before we actually get recorded, and we have to start all over again.
Start recording, yeah.
So this is a first for us. We haven't hashed it all up out in advance. But my name's Don Creech,
and I'm Perry Sykes, and you are listening to the Investor Resources podcast.
What's the biggest event of this last week? The Federal Reserve finally did what the market has been asking for since the first of the year: get out of the office and cut rates. And the debate has been between the bulls and the big bulls and a few bears along the way, just how big those rate cuts need to be in order to turn this economy around. Around from what? We're not in a recession, but there are lots of arguments that it's already begun because the federal data system is usually about a year late before it wakes up and says, oh, by the way, you know what we told you was really good? Not so much. So here we are.
12, yeah, we're missing a little bit here. So
yeah, and I listened to some commentary this morning with regard to the labor reports, because Mr. Powell said in his speech last Wednesday that we've conquered inflation. It's going to end up next year at the 2% target rate. The only thing that's still on the table is labor conditions. Yep. And you can't call a 4% unemployment rate disastrous. That's not typically recession territory. That's growth territory.
That's true.
However, those were not the revised numbers. There are revisions coming, and apparently when those next two revisions come, the private analyst that I listened to said, you're going to be surprised how bad the news really is. So the argument is the Fed cut rates by 0.5%. We may slip into financial jargon and call that basis points, but basis points is basically a penny on a dollar term. 1/100th of 1%. So they cut them 50 basis points, 0.5%, instead of a quarter. And unusually so in many decades, one of the voting Fed board members actually objected to what Mr. Powell was going to do at this point in time and wanted a 1/4 point cut. So we don't have unanimity at the Fed. And of course, Fed speakers go out and they express a lot of opinions. But what happens with falling rates? That changes the economic scenario for your investment routine, at least the assumptions that you're making about how you structure your portfolio. So there is rotation that has already started, and you're going to see more of it as we move through the fourth quarter, which starts next week.
And it's important even with the rate cuts. It's so important when you're looking at your portfolio and you're thinking about what do you need to do. Rates have been cut. It's been telegraphed that they're probably going to continue. What does that mean? What does it do anything automatically to the economy, to markets, both the bond market and the stock market? And quite frankly, the answer is no, it doesn't. You still have to be watching constantly to see where things are going to go, because you don't know what the rate cuts, especially at the very beginning. What are we going to get out of this? A lot of economists will tell you, inflation is much more a result of government spending than it is of interest rate levels. So, the rate cut is not going to stop Congress from their spending rates. And, you think, well, that's it. The stock market's off and running. There's all kinds of things that affect the stock market. It's never one metric. You can never say, okay, the first rate cut's in. That means here's what we do. you still have to wait. You still have to watch. You still have to follow trends, in our opinion, and kind of watch it unfold before you know what may be a good move coming up.
And one of the common assumptions, when we've talked about this in various podcasts, is that falling interest rates is good for bonds. Bonds have
Yeah.
finally turned positive since COVID, and we've gone through 4 years of negative bond returns. And just within the last few weeks, the year-to-date return for long-term bonds, and actually the Barclays Aggregate Bond Index, which is an assortment of bonds, finally is generating a positive year-to-date number. And people have been waiting a long time for that. I mean, you've been buying
Right.
bonds and you get a higher interest rate, but then you're losing your capital value. That's reversing. At least that's the assumption that many people are making, that because rates are going down, bonds should rise, right? Well,
Right.
maybe and maybe so. Here it looks like we have a millennial or a Gen Z asking the question. As I had a phone call with a 401k lady earlier today who said, I really don't know much about what's going on here with this. I have this money in my account, and I opened up an account at Robinhood, and I have my old 401k, and frankly, I don't know anything about what I'm
What are
doing
we
here.
doing? Yeah.
So that's kind of like this same question. Bonds should rise, right? Well, not necessarily so, because there are multiple ways to deal with bonds. Bonds are issued in various lengths of term, much like certificates of deposit are. I mean, if
Sure.
you go to your credit union or the bank and you say, I want to buy a certificate of deposit, and they'll quote you rates depending on whether you want 3 months, 6 months, a year, you want 5 years, you want 10 years. I don't think banks go much longer than 10 years. But I do remember back in the early 80s, you get a 10-year certificate of deposit, FDIC insured at 12%. That's how high
Oof.
rates were back then.
Mhm.
And mortgages the same time period, I know from dealing with clients at the time, 30-year mortgage at 21.5%. That's the highest one I ever saw. So we're not so bad off. But the good news is rates are coming down. They're not going to come down across the board. And why would that be? Part of that is because traders were already anticipating the rate cut. So, as the jargon goes, the rate cuts were already baked into the return and into the
There you go.
price. And now that we have it, that's reality. What's next? As I wrote this morning, investors are very fickle. We've been waiting for the rate cut. We got it. Now what do? We need something else to boost this thing further along. What's the next catalyst going to be? And right now, there's some uncertainty about that. When we're looking at rates, which would help equities, particularly small businesses, if interest rates continue to fall as the Fed says they will, and we don't have a recession that causes investors to quit buying stuff.
Correct.
Because if they quit buying, businesses will lay off people. And then what do those people do? They quit buying even less, or they quit buying even more. So
Even
they're
more.
purchasing less, which
Yep.
means somebody else gets laid off. I mean, that's a vicious cycle that's really hard to turn around. The Fed's is probably a little late in trying to get that job out of the way. But we'll see how rapidly they cut rates in the coming year. With your bond portfolio, the Fed controls short-term rates. They are going to fall. So you've been in a money market and you've been getting close to 5. Expect 3 before long, and 2, 2.5, sometime probably in the middle of next year. And if the Fed is right, and I'm not saying they are, probably 2 to 1.5 in a money market by the end of next year. That's the pattern that they have mapped out in what they call their dot plot, their forecast. That's a different environment than you've been in. these past couple of years when rates have been stubbornly high. Well, the rates have nothing to do with, but Mr. Powell and the board, Federal Reserve Board too, they've been stubborn about cutting it. It's
Correct. And those short-term rates of deposit rates and short-term CD rates, those are pretty much the only thing, in money markets. Those are the only rates you can pretty much guarantee those rates are going to fall. Those rates are going to fall, and borrowing costs will go down. If you have to borrow money, the interest rate's going to decrease with the federal funds rate fairly quickly and fairly much in step. But those are really the only things that there's not a lot of other uncertainty around. You really can't bank on a lot of like the bond market in general going up. You can't bank on the stock market in general going up. It very well may. Again, like you were saying, Don, are we gonna sidestep a recession now because the rates are dropping? That may help. It may help us at least get a soft landing. No guarantee of that. There's no guarantee we're going to get a recession at all either. We don't know. And that rate cut is not going to guarantee a lot of things other than short-term interest-bearing accounts. The rates are going to go down. And if you're borrowing money, the rates are going to go down. And outside of that, going to have to pay attention, going to have to watch what's going on. And as always, apply a disciplined approach to where your money is, because the market's still going to be in rotation and it's still not going to be consistent. We still have a good bit of volatility out there. The news is still driving a lot of volatility in the stock market, both good and bad. And that's not going to change in the short term either.
Well, and part of that news is whether or not we actually have a recession going on,
Yep.
and what do rate cuts mean as far as that is concerned. And I have an extra. That's not going to work. I thought I had a graph that shows this. So basically, what happens with rate cuts is dependent on whether or not for equities is dependent on whether or not we have a recession.
Hmm.
If we cut rates of the kind of cuts that the Fed is dealing with right now, and we don't have a recession, that's very strong for the stock market. And the returns when you get out 6 months, a year, a couple of years out, that's quite strong historically. What is not good is he's cutting rates because he's afraid that the recession has started. And when that has happened, and we don't have a lot of instances with this going on, but the two that come to mind are the tech bubble, cutting rates because the economy was collapsing. And that took
Right.
3 years, three and a quarter years to turn around for the market. And then the second one was the great financial collapse with the mortgage bubble and what happened there with the mortgage fraud. So that collapsed the economy and the market. Now, those were rate cuts associated with bad economic news. There is another time, but we have to go all the way back to the 70s. And during that period of time, we had high inflation and the economy was really struggling with similar issues to what we're dealing with today. Houses were cheaper, but employment was hard to come by. And inflation, we have supply issues, so prices could continue to accelerate. That's where the 21.5% interest rate mortgage came from.
Sure.
Actually, that was in the 80s. It took a decade of ramping up to get there. So if we go back into the 70s, we see economic difficulties, rate cuts associated together, and a very unstable stock market during that decade. Once we got past 80, 82, things have changed, and you could cut rates, slow inflation down. The economy was strong. Market continued to go up. We had a 40-year bull market, two disruptions: 2000, the tech bubble, and the great financial collapse in 07, 08, and ending in 09. And we're back to a new bull market. But if the recession is in fact in place, the next year could be pretty rocky as far as equity concerns. And what you
Definitely.
just mentioned, Perry, was basically process. What are you doing to pay attention to this
Yep.
instead of sitting back in an easy chair saying, the market always goes up, everything will be okay, except maybe not right away.
right? You can find plenty of people to tell you that. If that's what you're looking for, there are plenty of places online to go to say, well, that's it. Rates are cut, buy an index fund and hit the recliner. You're done. Markets are just going to go up until rates start to increase again. Just doesn't happen to be true. And it especially isn't true that what's going on in the market is reflected effectively in any index. It's usually the case that what's going on a little bit deeper in the market is what's really moving things around. And sometimes that's not reflected in the index returns at all. And you need to be careful with saying markets are really, really great or really, really bad when all it means is that the index isn't reflecting what's really going on in the market. And that's why we tend not to be index investors. We tend to try to be a little more targeted on the sectors that are doing well and trying, more importantly, probably avoid the sectors that are doing poorly. And that takes tracking data, and it takes the discipline to keep making those decisions based on the data and the prices and not what anyone's opinion about the market happens to be.
Well, that's certainly true in recent years, post-COVID, and we see that today, where the major indexes are being driven by just still a handful of stocks.
Sure.
Now, the mega cap tech stocks this last couple of months are not doing the same job, same impact on the indexes as they have for the last several years. People are saying, those things are really expensive, and we don't really know how they're going to profit from implementing AI, and how are they going to implement it anyway. Let's look at some places where we get better description, definition, and value, and rotate some of the money over there. And that's the reason that you pay attention to what's going on. That is a reason for diversification, but not broad, undisciplined diversification. What you just said, Perry, targeted, disciplined decision making, focusing on market leaders, getting rid of the laggards in your portfolio, because they hurt you over the long haul. That's probably a good point for us to call it a wrap.
You bet.
So down below is our subscribe link. If you aren't a subscriber, do so. When next when we get posted, you'll get notified. And we do webinars once a month on the first Saturday of the month. So that'll be coming up in another week, depending on when you read this or listen to it. But you can go to our website, iriradio.com is a shortcut. And there's a quick link there to register. If you can't make the webinar on a Saturday morning, we'll send you a replay link and you can watch it on your own time. There's no commercials in it either, so it's commercial-free webinar.
Bingo.
Anyway, hope you enjoyed this, and come back for more. We'll have more insights on another subject, but we're always focused on what's going on with the markets. Have a great day.